When you first step into the world of trading, whether as an independent retail trader or as someone walking across the polished marble floors of a bank's trading desk, there is one brutal reality that crushes illusions almost immediately. The market is entirely indifferent to you. It does not care about your personal circumstances, your dreams, your rent being due next week, or the fact that you need a winning trade to get back what you lost yesterday. On a bank trading desk, this lesson is driven into traders like a hammer striking steel, because those who cannot internalize it will eventually blow up their accounts, and often their careers along with it. The market is not your friend, not your enemy, and certainly not your confidant. It is a vast, complex system of supply and demand, liquidity and fear, driven by millions of decisions across the globe. To think it would ever bend in your direction simply because you need it to is the first illusion that has to die. Bank traders quickly learn to abandon the language of entitlement. There is no room for statements like, "I deserve a rebound," or "this stock has to go up." On the trading desk, every belief must be tested against price action, liquidity, and volatility. The trader who ties his or her identity too closely to the outcome of a trade is doomed. The market punishes attachment because attachment blinds you. You stop seeing the chart for what it is and start seeing it for what you want it to be. On professional desks, you'll hear the veterans remind juniors that hope is not a strategy. It is repeated often, because hope is one of the most expensive commodities a trader can buy. It costs entire careers. When you look at the price flicker on the screen, you are tempted to imagine it has a relationship with you, almost as if the market is trying to send you signals, or that it owes you a reversal after a series of losses. But the reality is harsh. The market owes nothing to anyone. You can be on your last few $1,000s or managing $1 billion book. The tape doesn't recognize you. It moves based on flows, on liquidity, on fear, on central bank announcements, on geopolitical shocks. The human mind craves patterns and meaning, but the market is ruthlessly impartial. This is why traders who last long enough shed the emotional baggage. They treat trades as experiments, not personal battles. On a bank trading desk, this indifference is drilled in by the sheer speed of the environment. Imagine being long a currency pair, believing you've spotted a technical breakout. Suddenly, a central banker speaks in Frankfurt, and your position is obliterated in seconds. No one on that floor turns to comfort you. No one tells you the market will make it right next time. The brutal lesson is clear. You are responsible for your own defense. If you leave yourself exposed, the market will strip you bare without hesitation. The screens do not blink back with sympathy. They just keep moving. Another layer of this truth is how quickly the market humbles those who bring ego into the equation. Some traders walk in believing they are smarter, sharper, or more intuitive than everyone else. And for a short while, they may be right. They may even win big early on. But the market does not recognize personal genius. Overconfidence often leads to oversized positions, neglected risk controls, and eventually catastrophic losses. On a trading desk, colleagues have seen this story play out dozens of times. The new hotshot, the genius who thought they cracked the code, suddenly takes a hit so devastating they never recover. It is not because they were unlucky. It is because they forgot the first principle: the market doesn't care. When you recognize this truth deeply, your mindset shifts. You stop asking, "Why is this happening to me?" and start asking, "What is happening here?" That shift, subtle yet powerful, is the foundation of trading discipline. It removes the ego from the equation. You are no longer a character in a personal drama against the market. You are a participant in a game of probabilities, of odds, of managing risk in an indifferent system. The market becomes less of a mirror reflecting your emotions and more of a field you study like a scientist, adjusting your strategies without anger, frustration, or desperation. This indifference also means your past doesn't matter to the market. Whether you had 5 wins in a row or 5 crushing losses, the next trade has no memory. Bank traders understand this in their bones. They cannot carry the weight of yesterday's mistakes into today's opportunities. To do so would be to hand the market even more of their power. The screens don't care that you are hurting. They don't care that you are desperate for redemption. If anything, your desperation is what the market feeds on, because desperation leads to reckless entries, poor exits, and a spiral of loss. The professional trading desk forces you to face this indifference every day, until it becomes second nature. You learn to detach, to see trades as just numbers, entries and exits. Instead of personal victories or defeats, you learn to manage your emotional capital as carefully as your financial capital. Because once you realize the market doesn't care about you, you stop expecting sympathy or fairness, and you start focusing on what you can control: your decisions, your risk, your execution. On the trading desks of major banks, there is a saying that circulates quietly but firmly: trading is not about how much you can make, but how much you can afford to lose. This statement sounds simple, almost too obvious, but within it lies the entire philosophy that separates professional traders from the reckless amateurs who treat the markets like a casino. Risk management is not a side concept or an accessory to trading. It is the core of survival. Without it, even the brightest minds and sharpest strategies collapse under the weight of inevitable market turbulence. When you walk into a bank trading desk, the first thing you notice is that everything is structured around controlling risk. The screens are not just filled with prices, they are filled with risk metrics, exposure charts, volatility indicators, and positions marked against capital. The institution does not allow traders to freely gamble. Every position taken is sized according to strict limits. Loss thresholds are set in advance, and stop-outs are enforced. In this environment, it becomes immediately clear that the art of making money is not glamorous bets. It is the discipline of preserving capital when markets move against you. Professional traders are deeply aware that losses are not just possible, they are inevitable. No one escapes them, not even the best. The difference between those who survive and those who vanish is in how they handle those losses. A retail trader might hold on to a losing position for weeks, telling themselves it will turn around, but on a bank desk, that type of behavior would get you fired by Friday. Risk is cut quickly, sometimes brutally, because the longer you let it grow, the more it poisons the account. The moment a position goes against you beyond the tolerance level, the rule is clear: get out, reset, and protect the book. Risk management extends beyond just cutting losses. It is about structuring every decision in advance. Bank traders don't enter a position without knowing exactly where they will exit, both in profit and in loss. They know how much of their capital is on the line and what percentage of it is at risk. This habit is ingrained until it becomes second nature. To take a trade without that clarity is considered recklessness, and recklessness is a fast ticket off the desk. By comparison, many retail traders jump into trades on gut feeling, with vague hopes of making money and no real plan if the market turns against them. The brutal truth is that such an approach is not trading. It is gambling with better graphics. Another key aspect of risk management on bank desks is position sizing. The traders who last know exactly how to calibrate their trade sizes relative to their overall portfolio. They understand that no single trade should have the power to cripple them. If a single loss can wipe out weeks of work, the position was far too large. On professional desks, size is managed with surgical precision. This is why bank traders can survive long enough to compound small edges over time. They are not looking for home runs that risk everything. They are looking for repeatable setups where the risk is always capped and the reward is proportionately greater. What makes this discipline even more vital is that markets are unpredictable by nature. Even the best analysis can be undone by sudden news, geopolitical events, or central bank decisions. No trader, no matter how skilled, can predict these shocks with certainty. Risk management is the shield against the unknown. It is what keeps traders standing when volatility spikes and everyone else panics. On the trading desk, you can feel the atmosphere shift when a sudden event hits the market. Screens light up, phones ring, orders fly. But amidst the chaos, the trained trader does not freeze. They already know their maximum exposure. They already know when to exit, and they act without hesitation. Risk management also goes beyond numbers. It is a mindset. It is the recognition that you are not invincible, that the market can and will humble you, and that your survival depends on respecting the limits. Ego is the enemy of risk management. The trader who believes they are too skilled to blow up, too intelligent to make a catastrophic error, is exactly the one who eventually does. On the bank desks, humility is enforced through structure. Systems, rules, and oversight prevent a trader from letting pride run unchecked. In the retail world, without those guardrails, many collapse under the weight of their own overconfidence. The paradox is that those who obsess over risk often make the most money in the long run, because while others are knocked out of the game after a few bad trades, the disciplined trader remains. They may not look spectacular in the short term, but over months and years, their capital grows steadily, protected by the armor of discipline. Every trade is taken with awareness. How much can I lose? How much can I gain? And is this worth it? The answer is never emotional. It is calculated, measured, and executed with clarity. On bank trading floors, risk management is not a suggestion, it is a religion. And every trader who has survived long enough to earn respect understands one thing clearly. The real game is not about predicting every move or chasing every profit. The real game is making sure that when the dust settles, when the markets convulse, when strategies fail and uncertainty reigns, you are still there, capital intact, ready to take the next opportunity that the market will eventually present. Inside the halls of a major bank's trading desk, there is no shortage of information. Research teams provide reports filled with economic forecasts. Analysts publish price targets, and flow desks monitor where the largest orders are moving. News feeds stream real-time updates of everything from central bank policy shifts to geopolitical tensions. At first glance, it seems that the battle in trading is simply about who can access the most data the fastest. And while it is true that information is an undeniable advantage, traders quickly learn a painful truth. Information by itself is useless without execution. The separation between a profitable trader and a struggling one often comes down not to who knew first, but who acted decisively and managed the trade correctly. On a bank trading desk, young traders often come in with the belief that if they read enough reports, analyze enough charts, or stay glued to the news long enough, they will somehow gain an edge. But the veterans know this isn't where the game is truly played. Everyone on the floor has access to Bloomberg terminals. Everyone sees the same data streams, and everyone hears the same rumors swirling across the markets. What makes the difference is not knowing but doing. It is the ability to cut through the noise, take a position when the setup appears, and execute it with precision before hesitation eats the opportunity alive. Execution is where psychology collides with reality. You might know that a particular stock is undervalued, or that a currency pair is about to break out, but when the moment comes to click the button, doubt creeps in. What if it's a trap? What if this is the one time the setup fails? By the time hesitation passes, the entry is gone, and the trade is either too late or no longer attractive. On bank desks, traders are trained to recognize this hesitation as one of the deadliest enemies of profitability. They are reminded constantly that it's not the knowledge that pays, it's the action. Consider the scenario of order flow. A trader may see a surge of buy orders flowing into the market, suggesting a large institution is building a position. That information is valuable, but the opportunity is fleeting. If you hesitate, the price adjusts and the edge disappears. Those who execute quickly can capture the move. Those who sit back thinking about it are left chasing. In this way, execution becomes the real currency of success, not information. The same applies news events. A central bank governor makes a dovish comment and the bond market reacts instantly. Traders who execute with speed and discipline lock in gains, while those who overthink end up entering when the move is already priced in. Execution is not just about speed, however. It is also about discipline and control. Acting quickly does not mean acting recklessly. On a bank desk, execution is planned in advance. Traders know their entry points, their position sizes, and their exit levels before they even click. This preparation allows them to move decisively when the moment comes, without the paralysis of second guessing. It is a paradox of sorts. The fastest execution often comes from the calmest preparation. The trader who has rehearsed the scenario mentally dozens of times can act instantly, while the unprepared trader is stuck debating with themselves in the heat of the moment. Another aspect often overlooked is that poor execution can turn good information into a loss. You may have been right about the direction, but if you chase the entry at a bad price, your risk-reward skew collapses. If you mismanaged your stop loss or failed to scale out when the market moved in your favor, the profit evaporates. Bank traders see this repeatedly. The rookie who had the right call but botched the execution, compared to the veteran who entered cleanly, managed risk tightly, and walked away with a gain. In the end, the market does not pay you for being right. It pays you for executing correctly. On a professional desk, execution skills are built the same way athletes build muscle memory. Repetition, structure, feedback shape a trader's ability to pull the trigger without hesitation and manage the trade without emotion. Veterans often advise juniors to treat execution like a craft, something to be honed day by day. Reviewing fills, studying slippage, analyzing missed opportunities, all of these are part of the training. Over time, this discipline turns execution into instinct. Information is abundant, And in today's markets, even retail traders have access to more data than bank traders did 2 decades ago. Yet this abundance creates a new trap: paralysis by analysis. Many spend so much time consuming data, flipping through indicators, and comparing reports that they never actually take a trade. They drown in information while others act decisively on the few signals that matter. On a trading desk, this type of paralysis is exposed quickly. A trader who cannot execute will see their P&L stagnate, no matter how intelligent their analysis appears. Ultimately, what trading desks teach is that the market rewards those who can transform information into decisive, disciplined action. Knowledge gives you the map, but execution is the act of walking the path. Without that step, all the charts, all the news, and all the insights are nothing more than intellectual decoration. The market does not pay for theories. It pays for trades that are entered with clarity and managed with discipline. If there is one universal truth that bank trading desks teach relentlessly, it is this: emotions are the silent killers of traders. They ruin more careers than bad strategies ever could. A flawed system, if managed with discipline, can at least keep a trader afloat for some time. But a sound strategy, when driven by fear, greed, or desperation, is quickly turned into a wreck. On a professional desk, this lesson is not taught through theory, but through the harsh realities of watching colleagues implode. Veterans can recall countless traders who had the intelligence, the skills, and even the edge, but who allowed their emotions to take the wheel, and the result was always the same: disaster. The environment of a bank trading desk amplifies emotions in ways most people outside cannot imagine. Screens flash constantly with shifting numbers. The air is thick with tension, and fortunes are made or lost in minutes. It is a pressure cooker. In this environment, emotions lurk just below the surface, waiting to dictate decisions. The fear of missing out when a market surges, the panic of holding a losing position, the greed of wanting just a little more profit before closing. All of these emotional traps present themselves every single day. What differentiates the survivors from the casualties is not that the survivors feel nothing, but that they refuse to let those feelings decide their actions. Fear is the first enemy most traders encounter. It shows up when a position begins to move against them, whispering that maybe this is the end, that maybe they should cut the trade prematurely, or abandon their strategy entirely. On a bank desk, fear leads to traders closing out positions far too early, locking in small losses repeatedly, and destroying the statistical edge of their strategy. Worse, fear often prevents traders from even entering good trades in the first place. They see the setup. They recognize the signal, but fear convinces them to wait, and when they finally build the courage to act, the move is gone. Fear robs them twice, once by denying entry and again by making them chase too late. Greed is just as destructive, but it disguises itself as ambition. It pushes traders to hold winners longer than they should, to ignore exit plans because the profit looks too sweet to leave behind. On the trading floor, you can see it happen in real time. A trader's position is in the green, the exit target is hit, but they tell themselves they can squeeze more out of it. Minutes later, the market reverses sharply, and the profit vanishes, sometimes turning into a loss. Greed also tempts traders into oversizing their positions, convincing them that if they risk bigger this time, they will accelerate their gains. This is how accounts get blown up, not by one bad trade, but by one greedy decision that magnifies the damage beyond recovery. Desperation is another emotional force that destroys traders quietly but surely. After a string of losses, many fall into the trap of revenge trading. They want to win back what was lost as quickly as possible, so they abandon discipline and take impulsive trades. On bank desks, desperation is one of the fastest ways to lose credibility. Supervisors can spot it instantly: the overtrading, the disregard for risk limits, the wild swings in position sizing. Once desperation takes hold, logic is gone, and trading becomes nothing more than gambling under pressure. The desk environment does not tolerate it for long, because desperation doesn't just harm the trader, it puts the institution's capital at risk. What is striking is that even the most rational traders are not immune. Emotions are not weaknesses that can be erased. They are part of human nature. The difference is that bank traders are trained to recognize and control them. They build systems, routines, and rules specifically designed to keep emotions from hijacking their decisions. Predefined stop losses, strict position sizing, and automated execution rules exist not because traders cannot think for themselves, but because in the heat of the moment, human emotion cannot be trusted. These rules serve as barriers between a trader's impulses and their capital. Veterans often speak of emotional capital as distinct from financial capital. Every bad emotional decision drains a trader's confidence, increases stress, and clouds judgment. A trader who allows emotions to dominate ends up exhausted, second-guessing every move, and spiraling into inconsistency. By contrast, those who learn to regulate their emotional responses preserve not only their money, but their mental stamina. This is why the best traders seem calm, almost detached, even when large sums are at stake. They are not emotionless. They have simply built habits that prevent emotions from steering the trade. The culture of a trading desk reinforces this reality every day. You will not see seasoned professionals shouting at screens or smashing keyboards. They may feel the same rush of adrenaline, but they know that visible emotion is a sign of vulnerability. The quiet trader, who methodically follows the plan, who executes with precision regardless of outcome, is the one who earns long-term respect. Emotional outbursts are seen as cracks in discipline, and cracks on a trading floor are opportunities for collapse. Over time, traders who survive understand that mastery of the markets is not just about reading charts, analyzing data, or predicting trends. It is about mastering themselves. The ability to detach from the highs of a winning streak and the lows of a losing day is what separates the professional from the gambler. The bank desk, with its relentless pace and unforgiving atmosphere, is the crucible where this truth becomes inescapable. Emotions will always be present, but if they are not controlled, they will destroy more than any bad strategy ever could. On the surface, a bank trading desk looks like a fortress of expertise, filled with some of the sharpest minds in finance, armed with cutting-edge technology, and surrounded by teams of analysts, economists, and strategists. From the outside, it would be easy to assume that this environment guarantees success, that traders working under these conditions must be winning far more often than losing. But the harsh reality is that even here, most traders do not last. The desks are littered with stories of bright new hires who thought they were ready for the challenge, only to be gone within a year. Some never recover from the psychological strain of losses. Others simply cannot adapt to the brutal rhythm of the market. And this is in an environment where the traders have better information, tighter spreads, and institutional backing. If they lose despite all these advantages, it reveals something deeper about the nature of trading itself. It is designed to humble the majority. The fact that most traders lose is not due to a lack of intelligence. The people who walk into these desks often come from elite universities, with backgrounds in mathematics, economics, or computer science. They understand probability, statistics, and modeling at a level far beyond the average retail trader. Yet, despite this intellectual firepower, many still fail. The lesson becomes clear. Trading is not a purely academic pursuit. It is a psychological and emotional battleground, and knowledge alone is not enough to ensure survival. One of the reasons most traders lose is that they underestimate the persistence of randomness. Markets often move in ways that defy logic, especially in the short term. A perfectly valid trade can be taken, one with sound reasoning and statistical backing, and yet it can still result in a loss because the market decided to move irrationally for a time. Traders who cannot stomach this randomness often abandon their strategies too soon, hopping from one system to another, never giving any approach time to play out. On bank desks, this behavior is referred to as system shopping, and it is a fast track to inconsistency. Another reason so many fail is the relentless pressure of performance. On a trading desk, you are not trading with your own money, but with the bank's capital. That capital comes with expectations. Daily profit and loss reports are scrutinized, and supervisors want to see consistent results. A few bad weeks can put a trader's seat at risk. This pressure magnifies every decision, making small mistakes feel catastrophic and tempting traders to force trades in search of redemption. Under these conditions, even good strategies can be sabotaged by the weight of expectation. The stress eats away at discipline, and when discipline slips, losses accumulate quickly. The structure of the market itself also ensures that most participants lose. The financial markets are a zero-sum or in many cases negative-sum game after costs are factored in. For every winner, there must be a loser, and the bank's execution fees, spreads, and slippage tilt the field further. Even on institutional desks, costs matter. A trader who wins slightly more than half the time can still bleed out slowly if their winners are too small and their losers too large. This is why so many bank traders stress risk management above all else, because without it, even being right more often than wrong is no guarantee of profitability. It is also important to recognize the role of ego in why most traders lose. Many enter the profession believing they will be the exception, the one who outsmarts the market and rises above the rest. For a while, a few may even succeed spectacularly. But ego tends to push traders into overconfidence. They take oversized positions, ignore stop losses, or believe they no longer need to respect risk controls. On the trading floor, this story repeats itself almost daily. The same ego that drives ambition is the ego that accelerates destruction. The market punishes arrogance without mercy, and the desks are filled with cautionary tales of brilliant but reckless traders who went from celebrated to forgotten in a matter of weeks. The survivors on these desks do not survive because they never lose. They survive because they embrace the inevitability of losing and build systems to withstand it. They do not take it personally when a trade goes against them, nor do they chase losses with emotional decisions. They understand that the desk is designed to filter out those who cannot manage themselves under pressure. Most traders lose because they are unprepared for the psychological war they must fight every day. And without mastery over their own impulses, no amount of data or analysis can save them. What makes this truth so sobering is that even those who lose on bank desks were better equipped than most retail traders ever will be. They had access to more tools, more knowledge, and more support, and still the majority failed. This is why the harsh lesson resonates so strongly. Trading is not about brilliance or even about access. It is about resilience, discipline, and consistency. Those who lack these qualities are weeded out quickly, leaving behind only the small fraction who can accept the grind, absorb the losses, and continue forward with clarity. On a bank trading desk, there is an unspoken understanding that what works today might be obsolete tomorrow. Strategies, models, and techniques that once delivered consistent profits can suddenly stop working without warning. Markets evolve constantly, shaped by technology, regulations, central banks, and the collective behavior of millions of participants. This constant change leaves only one reliable edge for traders: adaptability. The traders who survive and thrive are not necessarily the smartest or the fastest. They are the ones who can reinvent themselves in response to new realities without clinging to old habits. The idea of adaptability becomes clear when you look at the history of markets. There were times when arbitrage opportunities were abundant, when inefficiencies in pricing could be exploited daily. As technology advanced and algorithms dominated, those inefficiencies disappeared almost overnight. Traders who built entire careers on those small arbitrage gaps suddenly found their edge gone. The ones who survived were not those who complained about the good old days, but those who pivoted to new approaches, learning new instruments, building new ways to profit. On bank desks, this is not optional. It is survival. If you fail to adapt, the market leaves you behind without hesitation. Adaptability is not only about strategies, it is also about mindset. A trader who insists that the market should behave in a certain way is already losing. The market is not bound by personal expectations or academic theories. When conditions change, volatility spikes, liquidity dries up, correlations break, the adaptable trader adjusts instantly. They do not argue with reality, they flow with it. This flexibility allows them to navigate storms while rigid traders sink. On a trading floor, you can see this difference in behavior. One trader sits frozen, insisting the market must come back, while another quietly cuts their loss and repositions according to the new landscape. The latter lives to fight another day. The former is consumed by stubbornness. Technology has amplified the importance of adaptability more than ever. Algorithmic trading, machine learning models, and real-time analytics have reshaped the battlefield. Human traders are constantly adjusting to compete with systems that can react in microseconds. Those who fail to evolve, who rely solely on intuition or outdated techniques, find themselves irrelevant quickly. The best traders, even on bank desks, are not afraid to embrace these tools. They learn to work alongside technology, leveraging data science, execution algorithms, and quantitative insights to strengthen their edge. Adaptability here means more than just reacting. It means actively learning new skills to remain competitive in a rapidly changing environment. Adaptability also applies to time horizons. A trader who once specialized in intraday momentum might shift to longer-term macro plays when short-term volatility dries up. Similarly, a trader who thrived in trending markets must adjust when conditions become range-bound. Bank desks are filled with examples of those who failed to make this shift. They kept applying yesterday's playbook to today's market, refusing to adjust, and were eventually replaced by those who could. The lesson is clear. You cannot force the market to suit your style. You must reshape your style to suit the market. Adaptability extends to emotional resilience as well. When traders encounter drawdowns, adaptability determines whether they spiral into desperation or recalibrate calmly. A rigid trader sees a losing streak as a personal indictment and reacts with revenge trades, doubling down on mistakes. An adaptable trader sees it as feedback, a signal that something in their approach no longer aligns with the market, and they make changes accordingly. They adjust risk, review their process, and test new methods. This willingness to pivot, rather than defend ego-driven habits, is what allows them to survive long enough to recover. On the trading floor, adaptability is not glamorous. It does not look like calling every market move perfectly, or holding on to a system that always works. Instead, it looks like constant learning, constant humility, and a willingness to throw away what no longer serves you. Traders who adapt do not cling to being right. They cling to staying alive in the game. They are quick to admit when something has stopped working, and faster to try something new. In an environment where capital, jobs, and reputations are on the line, this quality becomes more valuable than raw intelligence or technical skill. Perhaps the most striking proof of this lesson is in how traders talk about their careers. Those who have lasted decades never tell a story of finding one perfect system and sticking with it. Instead, they tell stories of transitions, from equities to fixed income, from discretionary trading to algorithmic strategies, from one set of market conditions to entirely different ones. Their survival is a testament not to rigid brilliance, but to flexible persistence. The brutal truth that emerges is that adaptability is not just an advantage in trading, it is the only true edge that remains when everything else eventually changes.